afternoon from Los Angeles. It's Alyssa Corum here. I'm joined by Justin Nielsen. And on today's show, we're going to check in on the VIX. A pretty good image for you there. Just to put things in perspective, we're also going to be taking a look at two stocks holding up relatively well compared to everything going on. But of course, we begin with a look at the major indexes, our latest analysis. A very ugly day on Wall Street. The Dow closing down 10%, its biggest one-day percentage drop since 1987. The S&P 500, that's the chart you see there on a weekly basis, down about 9.5% for the day, Justin. It's just getting worse and worse.
Yeah, so there were a lot of headlines that were going on overnight. We had NBA canceling, or postponing the season, I should say, suspending.
Right.
Earlier today, we had the baseball suspending spring training. We had
celebrities now.
Yeah, Tom Hanks and Rita Wilson.
European travel ban.
European travel restrictions. There's a lot going on, and you had the federal stimulus, trying to kind of stem some of this with a big cash infusion, and even that could not stem the tide. So what we had is the futures market that was pinned, limit down. So that means it basically couldn't go down more than 5% until it opened. Once we opened, we had a circuit breaker, level 1. That means that it was down 7%. The S&P 500 was down 7% from the previous day. And
that happened Monday.
That happened Monday. So it's like, oh, this is becoming the norm. Everyone recognizes what a level 1 circuit breaker is because we did halt for 15 minutes, and that's just kind of to give people a chance to think about what's going on, think about what they've done, a little bit of a timeout, and basically what's happening is there's a lot of uncertainty here, and that's the problem is people are just not quite sure. We know that there's an economic impact here. Okay, Tom Hanks, he's sick, so they're shutting down the production. Film shoots are shutting down everywhere.
Everything has a ripple effect now.
Entertainment, okay, now ESPN, advertising, there's all sorts of things that, kind of ripple along from this. And not to mention what happens with the U.S. consumer. And, the market is a forward-looking mechanism. And so it's, trying to determine how do I price this in? And there's so much uncertainty now with the coronavirus. Now, what we do know is that this shall pass.
Yes,
that is,
eventually it will.
Yes, it's, hey, we're in Southern California, it's raining outside, we know that the sun will come out, eventually. It's just a matter of how long it takes us to work through this virus. And look, we've had pandemics before. This is not the first one. You can go back to the Spanish flu in 1918 if you want to see something really bad. That lasted maybe a year, and that was with a completely different health situation that we had, going on there. So,
and there is a lot of uncertainty out there, but one thing that we do know is that our market analysis has been on point every step of the way, not only for this correction, now bear market, but for those in the past and for the eventual upturns that we do see in the wake of these terrible markets.
And this is where you can kind of afford that optimism. If you've gone to cash, then you can. This isn't great, and no one wants to see people getting hurt. But when your portfolio is not diving, you can kind of think with a better head. When you have that cash position. And right now, someone on IBD Live said it best. Cash right now has a relative strength of 99. It's just that's a great place to be because you avoid a lot of this fear and panic, and that's what we're seeing right now because the market just doesn't know how to price a lot of this stuff in.
Right. Speaking of fear and panic, we do want to give you a visual representation of that by looking at a monthly chart of the VIX, that CBOE volatility index. Here you can see there, we need it zoomed out just a little bit more to really get the full effect of where we are now compared to where we were in 08.
Yeah, so a lot of times people look at the VIX, and what the VIX is, it's using the options on the S&P 500 to kind of give you a sense of the implied volatility. So you have the historical volatility when you're looking back in the past, but the implied volatility you can get from options prices to determine, hey, what is it that people are thinking the volatility is going to be like? And when you tend to see that volatility spike, that often coincides with bottoms, but it's not a perfect mechanism. It can be off by quite a bit. So in October 2008, which you see on the left-hand side, that's the last time we saw levels this high, and it got up to 89 back in 2008. That was in October of 2008, and for those of you that were investing back then, you might remember that the market didn't bottom until March 2009.
Yeah, so we don't know the length of this bear market, but it sounds like, of course, the odds are now to where this we don't know.
Yeah.
It may not be a quick recovery, though, so good to stay in cash.
Yeah, but again, it's very important to remember that a recovery will happen. This is something where with 2008, the financial crisis, there were a lot of concerns about like the systemic, like the system was going to break down. This is a health crisis, but the economy, it's going to probably take a hit. We kind of talked about how the news is hitting things and is expected to hit things. We're going to see those numbers start coming out more and more, but this is something that we can recover from because once the virus kind of makes its way through the population, hopefully we can stem that as much as possible, but eventually it will make its way through and, then we can kind of move from there.
Yeah, and when it does, you will need stocks on your watch list. So we've been going through all of our screens day after day,
Right.
taking a look at the ones that are showing the most relative strength. Now, of course, IBD's relative strength line measures price performance versus the S&P 500, so we want to be looking at stocks that are showing that outperformance.
Yes, exactly. And, just to be clear, because this is something that we got on IBD Live today, people are saying, hey, when you're talking about how a stock looks good, does that mean we should be going out and buying it? No.
Right.
This is our watch list. This is what we're doing to stay engaged. This is what we're doing to kind of keep an eye on what is holding up. And we can go ahead and start with Massimo because we're seeing a lot of the medical monitoring stocks that are holding up relatively well. Again, these are still coming down and getting hit. So it's much better to be in cash where you're not going to be taking that hit. But the things that are holding up and getting support at better levels than the S&P 500. I mean, we saw that the S&P 500 is now getting into territory that we saw back in the 2018 bear market. But look at Massimo. This is down maybe 4 or 5%, whereas the S&P 500 is down more than 25%. So that's why you see that relative strength line. That's that blue line at the bottom, why you see that going up. So a lot of people ask, well, it's down. How can the relative strength line be going up? Well, it's not going down. The price is not going down as much on the stock as the S&P 500. Exactly, it's relative.
All right. So Massimo on our watch list, as is Dexcom out of the diabetes space. These diabetes players we've been taking a look at. Now, this is another one that saw a pretty big loss intraday, but was able to come well off of its lows for the days. Not quite holding at that 50-day line, but it's trying to hold around that 250 price level.
Yeah, and so that's one of the things where sometimes we wait until the end of the week, to see how it closes relative to the 10-week line. Sometimes you have to have your line in the sand, though. So it really depends on where you bought these stocks. One of the reasons why Dexcom has a relative strength line that was moving up so much was because this stock was moving up when the market was getting into trouble, very early on. And so again, this one is down considerably from its high. It's down 19% at least from its high, but with the market down as much as it is, that's why the relative strength line is holding up. And those are the stocks that we're watching most, but again, that doesn't mean we're necessarily buying right now.
Right, because the proper entries that we will eventually see will be coming out of these consolidations that are now forming.
And those consolidations take time. So it's actually kind of good if we do take a couple months here. We had that 15-minute timeout today, with the circuit breaker. It might be good for us to take a couple month timeout here just to kind of think about think about what we've done, get those bases forming. And then, we're also right now, a lot of companies, it's hard for them to give guidance. They don't know what's happening. And so without that guidance, how is the market supposed to price this stuff in? So once we kind of get a better handle on this, then we can start seeing that guidance coming back in. People are getting a handle on it and, things will return to normal eventually.
Right. And clearly there are a lot of concerned investors out there, a lot of questions, but we did have a pro come on our podcast this week to walk us through his perspective on current market conditions, and that's Scott O'Neill. Of course, he is the CEO of IBD's parent company, Data Analysis Incorporated, and also the son of IBD founder and legendary growth investor Bill O'Neill. So he was able to share stories about how Bill has handled bear markets in the past. So very, very valuable insights on the podcast.
Yeah, and he's heard a lot of stories at the kitchen table, and he's weathered the storm a number of times himself. Scott is not new to this. He's been doing this for a lot of years himself, with great success. He was a portfolio manager for a while, and this is one of the things where having that perspective, and this was one of the things about Bill. He always had that optimism of, look, it might look bad right now, but we will come out of this, and when we do, there's going to be a lot of opportunities.
Yeah, so I will say, if you haven't checked out the podcast yet, now is the time. This is the episode that you really, really want to listen to or watch. We do have a video version as well, which is helpful because we do reference some charts, and there were some historical charts that were referenced.
Yeah.
So you can go to investors.com/podcast for the details on that. And of course, as Justin mentioned, the conversation will continue tomorrow on IBD Live.
And you'll be on, so
Yes.
you'll get to field some of those questions. Again, we are getting a lot of questions, but we are also getting a lot of comments that people are kind of very grateful for the steady hands that are kind of saying, look, this is how you handle this. Some of the things that we've been talking about, some of the strategies on how to deal with this. A lot of people have said that it's paid for the subscription for the next few years already.
Right, yeah, because stocks aren't buyable right now, but we're talking about portfolio strategies that you can really take advantage of right now in the current market conditions. So it's really, really key to be paying attention now more than ever, I think.
And the preservation of capital is really what we're all about right now. The thing is, you don't want to see your account dwindle to such a point that you have to make all that ground just to get back to where you were. It's much better to take a little bit of a drawdown, and then you can come back with power when those opportunities come about again.
All right. Well, once again, we will be discussing more on IBD Live, so make sure you check out investors.com/IBD Live for all the details on that. We can't wait for you to join us. All right, everyone. Thanks so much for tuning in, and we'll see you right back here tomorrow.